This is my preferred inflation index. Don't listen to talking heads. Don't listen to the Fed. Don't listen to government. They're idiots. Listen to the market. Listen to the market's message. And if we go and look at interest rates, they're not happy. The bond market is really not happy. Why? Because crude oil, and I've told you this repeatedly, crude oil is the ultimate sort of cost push inflationary component. It is the leading indicator in the inflation space. So if we're worried about inflation and we're worried about the Fed raising rates, if crude oil is ratcheting higher here, which we've clearly demonstrated, I think it still needs to go higher, then the bond market is not going to be happy. And at some point, the stock market's going to look over at the bond market and go, oh, shit, look at what's going on to interest rates. Also, too, and I thought this was interesting, Chris mentioned this yesterday, and I never got around to it, but he had pointed out that, for a while there, especially since, remember, last October, November, last October, I think that the powers that be saw how this inflation index, and this is my preferred inflation index. Don't listen to talking heads. Don't listen to the Fed. Don't listen to government. They're idiots. Listen to the market. Listen to the market's message. And here you can see, and I was, talking to you guys about that RJ Speaks guy, and he was going on about how if interest rates are this high and things are looking nasty for refinancing, there's a whole bunch of corporations that have refinancing that has to be done. If interest rates are this high and they're pressing higher, then we got major problems. So I think what happened here, and you can see the double top in the bond price, you can see the top in our inflation gauge. As I had sort of said, also, too, you can make the argument that there was a bit of a reprieve in energy prices. But the long and short of it here, a lot of our scuttlebutt was that this part of the yield curve was being completely manipulated by the Feds. And they were trying to talk the interest rate market down because of all this refinancing that has to be done. So did that refinancing actually get done? Here we are now into the end of the year. They brought the interest rates all the way right back down to lows. And then, like, literally, as soon as January 1st happened, they were like, okay, we've hit the reset button into the end of the year. Now we can let the interest rate market act the way that it wants to act. And then all of a sudden, boom, in comes big fat W's, and then more W's now. So unfortunately, it sure looks like interest rates want to head higher. I suppose the nail in the coffin here is for the consumer is going to be, does this mortgage rate start ticking back up? If it does, and I don't see any reason why it wouldn't based on what I'm seeing out of both the 10-year and our inflation deflation gauge, and you see the way that oil prices are acting here, and this sort of news out of the sort of globe, I don't know whether you can believe it or not, but the news is that China is basically back online and their economy is booming again. Well, only time will tell as to whether that's really real or not. If anything, if China's economy is coming back online, you're probably going to see it in these inflation gauges, and you're going to see it obviously in the 10-year yield. It's going to start ticking back up here. And you can see we've already done fog and bombs. If I draw a trend line off of the top, what a big surprise. 2.618 off of this bottom here is basically going to be a play against that trend line. And the ultimate question will be, still like this as a target. And what would be interesting is, I bet, this is a really good example of that sort of dead cat bounce into 38.2, 50% levels. You can see how they tried to top it and bring it back down, but boom. And is this on the China reflation? What I would find interesting about this image, and, if we look at bond prices, they should be the exact opposite. But I think what's going to happen here is this going to be a good old reload zone. If we do reload zones, what a surprise, 2.618 is coming up against 78.6. And so literally what this is suggesting is that 10-year yields right now are 4.3%, but my hunch is they probably want to get up to this 4 3/4. And then we'll start getting into the talk. Do 10-year yields have to go back to 5%? Blah, 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 blah. Yeah, we will see what happens. I suppose you could make the argument. You can kind of see how I already started to anticipate this. I wonder if this was the end of a move. Oh, yeah, it was. Okay, so we had boom, 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 boom. So that took us up into this objective. Not really a big shock there. If anything, what I'm thinking here is, do we do boom, boom? We'll do this a different color, like so. And then boom, boom. And this is the last thing in the world anybody is expecting. Ah, interesting. Look at that. Because I wouldn't be surprised if we go boom, boom and bot setup. All right. So 33.66. Ooh, close. That's an interesting one. This is sort of trading is more of an art form than a science. I wouldn't fault you if you said one low, two lows, three lows. Brian, I'm botting this thing out. I'm going long interest rates, which would mean that you're short bonds themselves. And if anything, I think I heard Druckenmiller say the other day that he was short bonds, which would make sense. But anyway, boom, 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 boom. That's A, B, C, D. But remember, these things can be alt A, B, C, Ds, right? So they could go as high as 127. They could go as high as 1.618. Ah, interesting. So there's 1.272 way up there. And then, oh, look at that. There's an 877 floating out there, 1.618. And this is the last thing that anybody in the public is expecting right now. Do you hear? If anything, what I'm hearing out of the public is, oh, we need to take interest rates down. Like in my stupid China, the politicians are actually trying to lobby the central bank to lower interest rates. And they don't realize there's no fucking way that the central bank in Canada can lower interest rates. Because if they do, then the currency in the face of this and the American interest rates going up, everybody's just going to sell their Canadian bonds and sell their Canadian paper, and they're just going to go buy the American paper. Already right now, I think the spread is about a quarter of a point, maybe even as close as a half of a point. This is just the conservative target. If things get absolutely out of control in the energy market, there's your aggressive target. So put that in your pipe and smoke it. So the question ultimately has been, why would the stock market and everything start to pivot? Why would Bitcoin pivot here? Well, I tell you, if oil prices are going to go through the roof and bond prices are going to collapse, then we're going to have a risk off trade. And I don't mean to be rude, but Bitcoin's a risk on trade, not a risk off trade.